Hey everyone, in this video, I'm going to update my recommendation for SoFi stock. Coming into the quarter, I had the stock rated as a hold. You're going to want to tune in to see if I'm changing that recommendation, upgrading it, downgrading it. What am I doing with this stock recommendation? You're going to want to tune in to see that. I've also put together an interesting comparison here of SoFi's results. Something interesting happened within the quarter that I wanted to highlight, something that is really good for the stock and something that might be a risk for SoFi stock. So let's jump right in with this update of my SoFi stock recommendation by reviewing its latest quarterly results.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
Starting with total net revenue increased by 27% to 537.2 million in the quarter, and this is a slowdown from the faster rates of growth SoFi was experiencing. Still, this is an excellent rate of growth. If anything, I feel that growth is not an issue for SoFi. What is an issue is the losses on the bottom line, which exploded in the quarter to 266.684 million. That was up 259% year over year. Now, management will point you to the fact that this was due to an impairment write down of goodwill, and will say, well, if you don't include that, our net loss wasn't that bad. Well, why would we not include that? SoFi has made several acquisitions over recent years, and by taking a goodwill write down, it's admitting that it paid too much for these acquisitions. And so why would we exclude that from the results? I want to include that because it tells me that management is in a habit of paying too much for acquisitions. And so I'm not going to exclude that from the results. The good news is that management still thinks that they expect positive GAAP net income in the fourth quarter of 2023. So they're going to swing to a profit in the fourth quarter after losing 266 million in the third quarter. So that remains to be seen, and hopefully the company can achieve that profitability on the bottom line. Total deposits in the quarter grew by $2.9 billion, which was up 23% in the third quarter to 15.7 billion at the end of the quarter. Over 90% of SoFi Money deposits are from direct deposit members. So a couple of good items here. First, increasing your deposits by 2.9 billion, solid. Remember, in the second quarter of 2023, there was a brief scare that deposits would leave SoFi, because remember that banking crisis where there was a bank run on a few of the smaller banks, and investors were concerned that money would leave SoFi and go to banks that were thought to be safer, like JP Morgan or Bank of America. That didn't happen. In fact, SoFi added billions of dollars in deposits. One of the ways they did that is by enhancing their FDIC insurance of up to 2 million instead of just 250,000. And so that really helped reinsure some customers who might have been concerned. The other thing that's good here is that 90% of SoFi's deposits come from direct deposit members. The reason that's good is because if you have your direct deposit going into a bank, that likely means it's your primary bank account. A lot of folks have multiple bank accounts, but only one of them is the primary bank account, the one they use to pay their bills, the one they use to spend money on when they're out filling up gas or going to a restaurant. And that's more of a lucrative bank to have a customer, is the one that they use as their primary one. So this is extra good news for SoFi. Not only are they attracting billions of dollars of new deposits, but they're also attracting these deposits from customers who are using SoFi as their primary bank account. Okay, so now I want to get into the lending side of SoFi's business, and they have an interesting breakdown here of the weighted average coupon rate and the weighted average annual default rate between their personal loans and student loans. And what you'll notice is that personal loans come with a significantly higher interest rate at 13.8% compared with student loans that generated just 5.3% in interest rate, in coupon rate. That's what customers pay the bank to get that loan. However, the downside is that more folks default on personal loans than they do on student loans. Just 0.5% default rate on student loans versus 4.6% default rate on personal loans. Almost 10 times the amount of defaults on personal loans compared to student loans. And the underlying reason for that makes sense. Student loans cannot be written off during bankruptcy, whereas personal loans can be written off during bankruptcy. One of the first things that consumers will stop paying if they get into financial trouble is their personal loans. They're not going to stop paying the car loans. They're not going to stop paying the home mortgage loans, or at least that's not going to be on the first on the list, because if they don't make their car loan payments, their car is going to be repossessed. If they don't make their home loan payments, their home's going to be foreclosed on. But if you miss your personal loan payment, all that's going to be taken away from you is a few points on your credit score. And so that's going to be the first thing that consumers default on when they get into financial trouble. This is where I would prefer SoFi not make so many loans to this category. Unfortunately, SoFi is becoming more and more a bank that makes personal loans, and I'll show you that a little bit later in the video. Particularly, even though the default rate is nearly 10 times higher, the interest rate, the coupon rate, is not even 3 times higher. So you're accepting, as a bank, as a lender, you're accepting a default rate that's 10 times as risky, but at the same time, you're only getting less than 3 times the interest rate at 13.8 versus 5.3%. I'd much rather have more of this 5.3% than this 13.8% because fewer defaults. Fewer defaults, less risky than this one. However, it's going in the opposite direction for SoFi, and that's a bit of a risk, and I'm going to talk a little bit more about that in just a little bit. The good news is that SoFi recently made an acquisition of a home loan company, which increased the home loan value to 356 million. That was up 64% year over year as they begin to benefit from that integration of that home mortgage company. I would like to see more of that from SoFi. Home mortgages is one area, and car loans is one area I would like SoFi to go more into if I was an investor in the company, and I'm not a shareholder of SoFi stock because of what I mentioned earlier. If people miss those payments, then you can repossess and you can foreclose, and that lowers your risk as a lender because you get back some money if your borrower does not repay, versus personal loans. If your borrower does not repay, you don't recoup anything. You don't have anything you can go back and take. So I mentioned SoFi is going in the other direction. If you look at the year over year growth in loans, you have 3.885 billion of origination in personal loans in the most recent quarter. Again, by far the biggest area of loans that SoFi made in the most recent quarter. That was up 38% year over year. The good news is, percentage-wise, the other two segments, student loans and home loans, increased 64% and 101%. But still, when you look at dollar value, this was a little over $450 million increase, and this was a little over $100 million increase in loan origination versus the personal loans, which was a more than $1 billion increase in origination. So I mentioned earlier I would go deeper into this loan comparison, and what I have pulled up here is a breakdown of the fair value of all the loans that SoFi has on its balance sheet. Now they have it broken down: personal loans, student loans, and home loans. And what you'll notice is a growing portion of its balance sheet is being weighted towards personal loans. From the third quarter, you can see, of 2023, 14.177 billion of its overall loans held on the balance sheet are personal loans, compared to a total fair value of loans of $20.2 billion. And that's been increasing over the years. I did a calculation breakdown from the total proportion of personal loans on the balance sheet year over year on the third quarter. And I have that broken out here. You can see in the third quarter of 2021, the total value of personal loans on the balance sheet divided by the total value of all loans was just 41% in the third quarter of 2021. That increased to 61% in the third quarter of 2022, and now in the most recent quarter that increased to almost 71% in the third quarter of 2023. So as the business grows, more and more of its loan portfolio is allocated to personal loans. It's allocated to personal loans, and we saw already that SoFi disclosed that that's a 10 times higher likelihood of default in that segment of the portfolio. So SoFi is at risk here if there should be a downturn in the economy that's worse than expected and people start losing their jobs. When they start to miss loan payments, the first thing they're going to miss is these personal loans. And so SoFi is at a greater and greater risk in this category. That being said, the main reason why SoFi, I think, continues to make these loans is because they are going after growth, and they've got these billions of dollars of deposits that they're attracting, right? I mentioned earlier that they added another more than $2 billion in deposits in the quarter. So now they have total interest-bearing assets of $22.856 billion. These are assets that they have that they need to pay interest on. And if SoFi is not making loans, then they're just paying interest on the deposits without making loans, and they're losing money in the business in that way. So they've got to use that money that they're attracting to make loans. Otherwise, they're just going to be going negative, just paying this interest on these interest-bearing deposits. The net interest margin increased to 9.79% in the average total interest earning assets, and so the net interest margin increased to 5.99%. That's the difference between what SoFi pays for money or deposits and then what it charges for loans. But what I mentioned earlier and what we looked at earlier, you can generate a higher net interest margin, to be sure, but then you put yourself at risk of greater defaults if your calculations are off in terms of what you think the default rate is going to be. So a balance that SoFi has to manage here in terms of making these personal loans, generating the higher interest, but also managing the default. Okay, so to answer the question if I'm changing my recommendation of SoFi stock, it's trading right now at a forward price to sales ratio of 2.735. A bit more expensive than it was trading at to start the year, lower than the highs it got to in the middle of the year. It was trading at a forward price to sales of over 4, and much lower than its peak valuations in 2021 when it was trading at a forward price to sales of over 12. For me, I'm keeping SoFi stock rated as a hold. The reason I'm not upgrading to a buy is primarily because of my concern with the personal loan portfolio. Otherwise, the business is doing an excellent job growing, attracting deposits, adding hundreds of thousands of new customers every quarter. That part of the business is fine. The part that I'm concerned about is that loan portfolio. And given that the Federal Reserve has increased interest rates so much, and we're going to likely see a slowdown in economic activity, I'm concerned if there starts to be greater job losses, the default rates on these personal loans. I'm concerned about that balance for SoFi. For that reason, I'm keeping it rated as a hold. All right, but before I let you go, if you've gained any value from this video, which you probably have if you made it this far, it'll really help if you subscribe to the channel. That's what allows me to continue making these kinds of videos. Without subscribers, I couldn't do what I'm doing. So I truly appreciate it if you would subscribe to the channel. Thank you so much for watching.